Okay, guys, today we have on Jake Chervinsky from the Hyperliquid Policy Center, sort of a new development in the space, but is getting a lot of press. Very happy to have Jake on. Jake, what is the Hyperliquid Policy Center? And what were you sort of put in this role to do?
Absolutely. Well, first of all, thanks for having me. Huge fan of yours and glad to be here. The Hyperliquid Policy Center is a nonprofit, independent research and advocacy organization. Our goal is to advocate for policy that allows Americans to access decentralized markets, starting with markets for perpetual derivatives, which of course is the number one product on the Hyperliquid blockchain. And we sort of fit in with the rest of the DeFi industry and the folks working in the crypto lobby to try to advance good policy broadly. The DeFi Education Fund, for example, where I'm a member of the board of directors, is really the sort of number one premier organization doing all sorts of DeFi work. Our goal at HPC is much more narrow. Our goal is to change regulation so that Americans don't hit a geofence when they open up the Hyperliquid app. And then the same thing for everything else on Hyperliquid and frankly, other DeFi protocols, perps, dexes, et cetera, to make sure that Americans can get the most benefit out of this new technology.
What does your day-to-day look like? Just tell me, was this developed in the past? Like the Policy Center was created in the past, couple months? So it's like a brand new organization. What do you do on a day-to-day basis?
Yeah, so we just launched 1 month ago in the middle of February. So we're still, getting everything set up. And we are, a full-fledged independent organization. So, my top priority as CEO is still, hiring and building the team, getting all the operations set up and everything like that. So, we're trying to run fast out of the gate, but still handling a lot of the typical things that any startup in the world handles, because we really are very much like any other startup, except instead of selling a product to the market, we're trying to sell, good upgrades to regulation to policymakers here in DC. But in terms of the substantive work, frankly, most of what we do is more like a law firm than anything else. So, I have a full-time lawyer on staff. We've already engaged outside counsel to work on these substantive questions of how do you change laws and regulations to open up the US market for retail access to DeFi perps. It's a pretty big legal challenge more than anything else. So it's us talking to our own lawyers, doing work to figure out what are the best arguments as a matter of policy and law, and then taking that to the policymakers. And that breaks down between the agencies, so the SEC and the CFTC, and then also Congress working on things like the Market Structure Bill, the Clarity Act, which has been, in the news a whole lot. So I think you can think about it almost like a law firm, except instead of having a whole bunch of individual clients working on their matters, our client, although not technically speaking, is Hyperliquid and the Hyperliquid ecosystem. And our goal is to achieve good results that benefit Hyperliquid.
Yeah, that makes sense. I think also this is maybe slightly different and hopefully interesting for listeners because the scope is slightly more narrow here, right? Like you're focused primarily on first and foremost, like derivatives and Hyperliquid, which obviously its biggest product is perps. So a lot of times, the reason I say this is because a lot of times I'm talking to lawyers and they have, 18 different things to juggle and there's all sorts of different things. So I want to kind of narrow this down then. What is it, you talk about changing regulation, like what is it in the current form that you are focused on with regards to perps, Hyperliquid? You talked about the geofencing thing, like that's a good example. What is it right now that you're saying like this is a regulation that needs to be changed and like I'm advocating for this? What are some of those like sort of more specific examples?
It's a great question. And before I get to the substance, just to emphasize the point, DC did not need another general DeFi policy organization, right? The reason for the purpose of HPC's existence is that perps are not legal to trade off exchange through a DEX in the United States. And we need to solve that problem. There's obviously other problems where Americans can't get the benefit of DeFi, and we'll focus on those as those opportunities arise. But the reason that HPC exists is because Americans can't trade perps on Hyperliquid, and they should be allowed to do that, right? It's a fundamentally better product than what they can trade on CME or CBOE through Robinhood, et cetera. So to get to the substance of it, the problem is the Commodity Exchange Act, which is the federal statute that the CFTC administers and enforces. And the CEA, after it was changed by Dodd-Frank after the global financial crisis, is designed to assume that there is a centralized intermediary at the center of every derivatives transaction. And in part, this was a reaction to the global financial crisis, right? Where regulators basically saw the entire global financial system almost get destroyed by these weapons of mass financial destruction, derivatives. That's how they were considered after the financial crisis. And the answer to the financial crisis was to say, we need the regulator to ensure that it can observe transparently where leverage is building up in the system so that this kind of thing doesn't happen again without regulators knowing. Because at the time, all of those derivatives that were building up leverage in the system were being traded without the CFTC having knowledge. And at the time, the best way for the CFTC to have that transparency was just to force all of those derivatives to trade through a centralized intermediary, a DCM or an SEF, a swap execution facility. And that allowed those intermediaries to report to the CFTC where leverage is building up in the system, right? Now we have public blockchains, permanent immutable ledgers that any person can monitor in real time without needing some intermediary to report to them. But the law, as it stands right now, doesn't allow derivatives to trade off exchange without a centralized intermediary on a public blockchain. So that's our goal, is to help the CFTC update those regulations so that DeFi perps are accessible to Americans. The CFTC has the statutory authority that it needs to do that. Congress does not need to pass new legislation. They don't need to amend Dodd-Frank or the CEA in order for the CFTC to do that work. But it is a fundamental change in derivatives market structure, and it does raise all the same core principles and underlying policy reasons why we have the CEA, the Commodity Exchange Act, in the first place. So it's not an easy lift, and it's going to take a long time and a lot of work to get us there.
What would this look like in practice? Is this new licenses specifically for perps dexes, or is this just a blanket, anybody can do this? Like, what does this look like in terms of moving from the current version, which, you talk about geofencing, right? Like, well, okay, I won't say anything, but like the reality is that a lot of these end up offshore, and there's really no way to prevent it. And like intuitively, for somebody who is not a lawyer and not like dealing with the CFTC, it's like, okay, well, why don't they just let them act on shore? But I know it's not that simple. So what does that actually look like when it comes to like what your efforts are now? Is it, like a license? Is it like just a gradual acceptance? Maybe a little bit more like there.
Yeah, there's two ways to look at it. One is we need a new licensing regime for DeFi. And the problem right now is if you want to go get licensed with the CFTC and then offer a derivative, whether it's a future or an option or a perp to the US, you need to go get a DCM license, a designated contract market license, right? But a DCM is like any centralized exchange. There is an operator of the exchange. They are capable of doing anything and everything with respect to transactions, users, how the system works, how orders are matched, everything. It's totally centralized. This does not work for DeFi. So as of today, even if a perps DEX developer like Hyperliquid Labs wanted to go get a DCM license, they couldn't do that for the current DEX. So one way of thinking about this is, okay, let's come up with a new licensing regime, the decentralized DCM, and the developers of a DeFi protocol could go in and get that license. I think the challenge with coming up with an alternative licensing system for DeFi is that in principle, DeFi done right does not give the developer the same level of control that they would need to be a CFTC registrant in the first place, right? Like if you imagine an immutable protocol or even a protocol that gives the developers some upgradability or admin rights, that's fundamentally different from what a traditional DCM is doing, and trying to shoehorn them into this licensing regime where what you want is for the developers to be able to throw their hands up and say, we're done working on this thing. We're just walking away from it, but it's going to keep operating exactly the same as it was the day before. Doesn't really make sense to force them to go in and register and be regulated in that way. So the other way of thinking about this is not a new licensing regime. It's an exemption from registration, right? Some type of either true exemptive relief or guidance from the agency that says, provided the technology works this particular way, there is no one who should come in and register. Or provided that the protocol works in certain particular ways, we're not going to require the developers to come in and register, even though we are still going to have some degree of oversight over what's going on in the protocol. My preference is for the latter. I think it's more true to DeFi. It also solves a separate problem, which is the Commodity Exchange Act, in many cases, requires the application of the Bank Secrecy Act to the registrant. Not in every case, not for a DCM, but for the front end provider who might be classified as an introducing broker, NIB, or a futures commission merchant in FCM. They're just automatically covered by the Bank Secrecy Act. This means that they have to KYC every user that's going through their front end. And to me, that's not what the Bank Secrecy Act is meant to do. It's not what the CEA is meant to do for someone who is operating a non-custodial front end. And so an alternative regime that does not require registration, but rather is exemptive, is going to be, again, truer to DeFi in that it's going to allow people to access the system without completely abandoning their privacy and turning developers into basically an arm of the surveillance state.
Yeah. Is that one of it? So I know there's like a lot of different things in motion here, but is that one of the big hangups right now is the bank secrecy aspect of it with KYC? Are we making any inroads there? Maybe like I'd say this is a crypto Twitter thing, right? So I'm now deferring back to somebody who actually deals with the law. But we all, like a lot of us collectively believe that KYC is this like burdensome, sort of inefficient, surveillance regime, and it probably does more harm than good. Okay, so that's like the reductive level. Is this just something that we believe, or are we making inroads here with legislators and policymakers? Are they understanding where we're coming from? Maybe specifically with regards to this kind of like bank secrecy and then KYC, AML stuff.
Yeah. Some are, not as many as we need in order to achieve the result that we want. I think that it's a hard argument to make to people who are just used to the system as it is. And especially people who hear from law enforcement or from the intelligence community or from national security experts every day, where they say, look at this public blockchain. North Korea is using it to fund their missile program. And it would be much better if this blockchain just didn't exist. And a lot of policymakers are still at this stage of not really understanding that this technology is going to happen. It already has happened, and it can't be undone, right? The bell can't be unrung. And so it's a real challenge to explain to those folks that just applying the traditional KYC regime to this new technology doesn't actually achieve the results that you want to achieve. It doesn't stop North Korea from getting access to the system. It just stops Americans from getting access to the system. And it doesn't capture the bad guys. The bad guys are going to find a way to access a public blockchain, whether you like it or not. I think that's increasingly true with, the ability of any person to Claude code their own front end now, right? Yeah. And I think that the KYC regime is becoming even less effective as identity fraud becomes trivial, right? Like it used to be at least a little bit hard to get a fake ID that would allow you to pretend to be someone else for KYC purposes. Now, literally everyone has access to that capability at any moment. So like this is an argument we have to make, but the problem isn't so much saying KYC doesn't work. KYC is an invasion of privacy. KYC creates a honeypot for hackers to secure massive amounts of right? Like policymakers get this stuff. But then what they say is, okay, what's your alternative? So how do we stop illicit finance on chain? How do we prevent bad actors from exploiting this system? And I think the industry still has a lot of work to do to come up with alternative risk management tools short of KYC that actually stop this stuff from happening. And that's, to me, the big challenge. Explaining to policymakers, look, it's not just that we're saying throw your hands up in the air and give up on stopping the bad guys. We have other tools that we can use that doesn't require the Bank Secrecy Act, but still lets law enforcement do its job and exclude bad actors from the system.
So like, I know I'm just asking you to kind of, I'm asking you to kind of philosophize yourself here, but like, what does that look like in practice? Like if you had to, we have a lot more work to do, but like your idealized vision of this, what are some of the attributes of that? Maybe, like a lot of people have proposed like ZK identity, stuff like this. Right. And it's hard to know like how much of this is real or fluff or whatever, but like what are some of the compromises in your mind that could be made with something like this? If, again, we can't just say give up and like let anybody, let North Korea trade perps or whatever it may be.
I think it starts with the low-hanging fruit, right? The low-hanging fruit is like, we know that there are certain addresses on chain that are either sanctioned, as in we know that they are under the control of some bad actor, or they're closely related to sanctioned addresses where it is very reasonable to assume that they are under the control of the same bad actor. I think it is very reasonable to say, if you are a US person and you are offering a product that you control, you should not facilitate transactions with those sanctioned addresses, right? So like that could look like a requirement that the front end provider, if they see one of those wallet addresses connect to their front end, that they don't allow the front end to use that service. I think that's totally reasonable and something, frankly, is the industry standard already, right? Like if you look at any DeFi front end in the US, they're already doing sanction screening. And I think it's very reasonable to say in regulation that that kind of thing is required. Then there's protections that require transaction simulation in the front end, right? So there are many different providers of this type of technology like Blockade or WebAssy that get plugged into basically every front end, where the front end will simulate the transaction to make sure it's doing what the user actually thinks and isn't just sending their assets to some scam wallet. And that has actually protected a huge number of people from being the victims of fraud and have stopped a lot of, bad actors on chain from taking advantage of those users. So I think that that's also pretty reasonable. It's sort of left of the boom, like before the transaction is done, ways of addressing potential illicit activity. Then there's forensics, right? Like a lot of wallet providers or front-end providers will work with some forensics firm like a TRM Labs or a Chainalysis. And what they'll be doing is looking at where the transactions are going after they've been, executed, using the benefit of the front end. And I don't know that that's legally required. I think it probably should not be legally required for people to do surveillance on chain for transactions they have no control over. But nonetheless, I think it is an appropriate thing for a front-end provider to be looking out for the best interests of the ecosystem, right? So they can be doing some right of the boom, right after the transaction is done, monitoring to help law enforcement identify what's going on chain. I think all of that is very reasonable. Very importantly, just before I finish this thought, none of that requires changing the protocol. And this is where I would draw the line. What we should not be doing is what some people have called protocol level compliance, where we say the developer of the protocol could build the protocol differently to exclude certain activity. And so we should stop developers from building truly permissionless protocols, just because if we force them to build compliance into the protocol, that will exclude bad actors from the system. That to me is a sacred aspect of DeFi that should not be sacrificed just for the sake of trying to limit illicit activity. These protocols will exist. They will be permissionless. And if we force the good actors to build compliance into the protocol, all we're going to do is drive liquidity into the permissionless offshore non-compliant protocols. So to me, that's where the red line is.
But is the problem there that the people who are building these compliance in protocol are lobbying or pushing for, look, it can be done, and therefore this, right? Maybe not asking the current iterations to change, but saying, look, it can be done in this way. This should be the legalized form going forward. Like that is also a risk. And I think there's been discussions about this. Like I won't name any. Actually, I don't know exactly which ones are like taking this stance, but that is one of the equal concerns there from my perspective is, okay, yeah, we're not going to ask Hyperliquid to change. It can continue to exist offshore. Maybe we even give it some type of safe harbor thing. I'm using Hyperliquid as an example here, by the way. I'm not singling it out. But there is some version, Coinbase, Robinhood, whatever has a license to do it. And this is the one we're going to support and, fully legalize in return.
To me, that's a question of commercial competition in the marketplace, not a question of regulation, right? Now, are some of those types of builders coming in DC and arguing the government should ban the alternative or should prohibit people from accessing the alternative? I honestly haven't heard that. It wouldn't surprise me. I'll call them out if you won't. I think that's sort of baked into the Canton argument, is that a permissionless blockchain is too risky. And the only way that institutions should be able to access what they call DeFi, but is really just on-chain finance, not really decentralized finance, is through a permissioned validator set that is, explicitly KYCing or excluding people who shouldn't have access. Maybe that is an argument that they're going to make to policymakers. My job is to stop that outcome from reaching fruition. And I don't see policymakers being compelled by that argument either. I don't think there are very many policymakers who want to push forward a ban on DeFi at this moment. That's certainly what the Biden administration wanted to do through Gary Gensler. And it's what the Department of Justice in some ways was trying to do through the prosecution of Roman Storm, the developer of Tornado Cash. Very sadly, the DOJ is still going after Roman. So they've actually decided to retry him on 2 of the 3 charges that were hung when the trial happened previously. And so, yeah, there are still people who feel like permissionless blockchains are so risky that we should try to drive them either out of the United States or drive the volume to 0 or as close to 0 as possible to limit the amount of illicit activity that can occur there. But I don't think that that's the majority of people. I don't even think there are very many people who think that. So to me, the question really is just, what are institutions willing to do, and what kind of risk tolerance do they have, or what are their compliance concerns to get comfortable using a permissionless protocol? And that's more an argument about the sort of commercial viability of these decentralized products rather than whether there's going to be regulation banning them.
Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while. The Ellipsis team is one of the few that I can consistently point to and say, these guys really know what they're doing. Ellipsis Labs brought capital-efficient order books to Solana and started the Prop AMM revolution with SolFi. Altogether, they've saved retail traders tens of millions of dollars by reducing slippage on spot markets. They're bringing the same level of expertise to perpetuals with Phoenix, which is live today. Ellipsis Labs is backed by Paradigm, Electric Capital, and Han Ventures. I would consider them the foremost experts in crypto market microstructure. The best part is that Ellipsis Labs is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer looking to work with a DeFi team that's already proven itself in the market, go to ellipsislabs.com/careers.
So I listened to this podcast I'm ashamed to admit this. It was the All In podcast with the new chair of the CFTC and then chair of the SEC. And well, what I got from it was a lot of stuff I think a lot of us in crypto probably already know or have heard about, but they talk a lot about this collaboration now, and that these 2 agencies who were, very reluctant to work together in the past, oftentimes sort of at odds with how they viewed, regulation of different assets and their role, are now working together, and this is a positive development, allegedly, right? I don't know. But the point is like they're, at least with regards to crypto, it does seem like they are in discussion, which again, that has to be positive in some regards. Is this true? We got some positive statements like on the non-custodial wallets, no action letter. We got some clarification of the Howey test. It seems like we are making inroads here. How well do you think the SEC and CFTC are looking at this? Maybe just wherever you want to go with this question, but working together and together with regards to crypto.
It's very true. It is real. They are describing it as harmonization, and the harmonization is very real. It really is happening. And honestly, it's such a refreshing sight, because historically it wasn't just that the agencies didn't work well together. It was that they were in a sort of Cold War where they would publicly say that they are cooperative, but actually they would be taking directly opposing stances on how crypto should be regulated. It was a turf war, right? And the same thing sort of played out to some degree in Congress, where, one problem with getting market structure legislation done before this current effort was that the committees had difficulty separating the line between what the SEC would regulate and what the CFTC would regulate. All those problems have basically disappeared. And a huge part of that is, the committee's working much better together through this round of Clarity Act negotiation, and also the chairs of the agencies truly being in lockstep about what they want to see for crypto. So the approach that they're taking right now basically is to address all of these issues collaboratively. So we're not going to end up in a situation where the CFTC takes one view and then the SEC takes a different view. That is absolutely crucial for us making progress with the agencies. Even if we don't end up getting market structure legislation done, the agencies have to figure out where the line is between what the SEC regulates and what the CFTC regulates. The best example of this historically is whether a token is a security regulated by the SEC or a non-security commodity regulated in part by the CFTC. And we got this guidance from the SEC a couple weeks ago in the form of an interpretive rule that basically said, look, here's where we see securities, and here's where we see securities transactions that we regulate, and here's where we don't. And that's where the CFTC picks up the thread. So I think there's a huge opportunity for the agencies right now to work together. And specifically, the way in which they're working together is on Project Crypto. Like, this could not possibly be better for us and for the industry, where Chair Atkins, who took his seat maybe 9 months or so earlier than Chair Selig, announced Project Crypto, got to work on it. In the meantime, basically nothing was happening at the CFTC because we didn't have a new chairman in place yet. And then for Selig to come in and announce, we're working closely with the SEC. We're also launching Project Crypto. Here are our priorities. Extraordinarily bullish on what we can accomplish in DC in the next 3 years. I do want to emphasize that this stuff takes a long time to do right, and especially where you need both agencies to be involved, and then where you have interests outside of those two agencies, like at the Treasury Department on the KYC issue that we were just discussing, right? Rulemaking that the agencies do will go through the interagency review process, and Treasury will weigh in, and so will many others. So stuff takes a long time, but it is extraordinarily positive. And I think, another reason for HPC's existence right now is this is the moment that we can get this stuff done.
Yeah, so that kind of leads us into the whole clarity thing. Okay, so actually let's talk about one thing first, which is that you kind of pointed out the other day, there's been a lot of talk about specifically the stablecoin thing because it's the stablecoin yield, because it seems to be the holdup. But you pointed out that, and hang on, I don't want to misquote you. Okay, there's the BRCA point about clarifying non-controlling developers and providers are not financial institutions subject to KYC obligations. So this again is something more kind of unique. I say unique. This is something more specific to what you do. What is this point here with regards to clarity that you're kind of like really pushing?
Yeah, so like just to zoom out for 1 second, like why are we trying to do market structure legislation? I mean, there's a couple of reasons. One is we just want good regulations set in federal statute that are going to be durable no matter what the next administration thinks. If we go back to Gary Gensler, who absolutely hates us, right? But the other thing is that point, which is we need the bill to protect us from that future hostile administration, right? What we don't want to do is pass a bill that just says the agencies get to regulate everything in crypto, including DeFi, however it pleases. Because the way that we survived the Gensler era was basically by saying the agencies lack authority to regulate this industry, right? Digital assets are a fundamentally new type of technology not contemplated at the time that Congress enacted the regulations, those statutes that the agencies currently administer and enforce. And unless Congress does something new to give the agencies more authority, the agencies cannot regulate this space. And that's literally what kept us alive through the Gensler era. I say that from experience. I was at the Blockchain Association, our main trade group, as chief policy officer, filing lawsuits against the SEC during this time, right? So if we pass a market structure bill now, which says the agencies have plenary authority over DeFi developers, let's just hope that they're nice to us going forward, then we made a huge mistake in market structure legislation. The key point to make sure that we have protection from a hostile administration is ensuring that DeFi developers are not misclassified as securities or derivatives intermediaries, which is what Gary Gensler was trying to do, right? He was trying to say Uniswap Labs and every other DeFi developer is just an ordinary national securities exchange that has to come in and register, even though there is no actual way to come in and register. We also have to make sure that DeFi developers who do not have custody of user funds cannot be misclassified as money transmitters or financial institutions under the Bank Secrecy Act. This is what, former Attorney General Merrick Garland at the DOJ through the Southern District of New York accused Roman Storm of, and in fact convicted him of operating an unlicensed money transmitting business, even though he literally did not have the technical ability to transmit money on behalf of any other person. So we need those protections built into the bill. The bill has basically everything that we need in the Blockchain Regulatory Certainty Act, which is the section of the bill that says a non-controlling developer or provider, meaning someone who does not control user funds, is not a financial institution under the Bank Secrecy Act. The problem is that the bill draft that came out before the Senate banking markup in January, which did not go forward after Brian Armstrong infamously tweeted that he didn't want it to go forward, we can come back to that, had another section in it, section 301, which is colloquially known in DC as the decentralized in name only provision, which kind of says like, yeah, even if you're a developer who doesn't have custody of user funds, if you have some ability to upgrade or change the protocol in any way, then maybe you're still a money transmitter. And that basically means every single upgradable protocol in DeFi could be banned by a next administration that wants to say all those developers are money transmitters. They have to do AML compliance, meaning KYC of every user of the protocol, which is literally not technically possible. And that means there's no crypto in America. So I guess to conclude the point, we will have failed in creating a market structure for crypto if we cannot protect crypto developers, because there will be no crypto in America if we cannot protect those developers. So to me, that's the key issue in the bill.
A lot of the things that we believed, and I've talked to others about this, but a lot of the ideas that we pushed forth as this is like non-custodial or decentralized, it doesn't seem maybe that it matters as much as we thought. And this is a point that you kind of come to realize. I look at some of these protocols and I wonder, I'm trying to think of how to say this because I want to be tactful, but I also want to ask the question correctly. When we talk about, so you were kind of talking about developers. I want to ask about protocols maybe specifically. When we say something is decentralized, this is like a fairly wide spectrum, and I don't usually like saying spectrum because I think it's oftentimes used to kind of bastardize when something is decentralized. But the point is that something like an L2 with a single sequencer is different than a blockchain with 100 or 500 or 1,000 validators that are all they're all different entities and they're all in different locales, if you will. So how much has this mattered from, going forward? And we'll talk more about the clarity in a second, but like how much are these ideas that we believe in conveying with, legislators, policymakers, like, are they differentiating this stuff or not really? And also, do we want them to differentiate or not really? When it comes to, like, for example, who's validating these transactions, who actually has control over the protocol? So it's a really, really poorly asked question, but you get the gist.
I do. And this is the key challenge right now. And I remember, 6-7 years ago, I was general counsel at Compound Labs, and all of DeFi was like 10 immutable protocols on Ethereum L1. And life was just a lot simpler back then, right? Now everything wants to be called DeFi, whether it's decentralized or not. And I think there is a huge spectrum. And although it makes it complicated, I think we have to engage with that challenge. I think from a DC policy perspective, there's sort of two different camps to oversimplify. One understands that there is nuance here and looks at the issue from the perspective of what risks are there that are appropriate to address the regulation, and how does the decentralized nature of the technology natively address those risks? And then how does it not address those risks? And in those cases where there are gaps, what regulation is still appropriate in order to address those gaps, if any? And I think that is like the correct and very reasonable approach. I don't think there's anyone really left who is serious in Washington who takes the sort of crypto anarchist libertarian ideological perspective of like, it's on a public blockchain, therefore regulation is entirely inappropriate. We should just say that there cannot ever be regulation of DeFi. That's not a serious position, and it doesn't result in DeFi sort of reaching the pinnacle of its potential in the United States or elsewhere. So I think that the sort of people of good faith are in this camp of trying to figure out how does the tech actually address the risk, and then what regulation is appropriate after that. There's another camp which basically says decentralization is not a thing. This doesn't exist. It doesn't matter that there are many validators on the blockchain that are validating transactions. That is a group of persons who should be regulated, right? Like the Bitcoin miners are a group that they're carrying out a financial service, and they should be regulated as such. And unfortunately, there is still a pretty significant contingent, mostly in the Democratic Party, although I would say not exclusively, the Elizabeth Warren types who really just don't think that this stuff matters at all. And to the extent that decentralization is real, it is a net negative. It is worse for the financial system because the financial system is better when there is a centralized intermediary that the government can go to tell what to do. And we really are still having that sort of core debate. Is DeFi good or bad for the financial system broadly? And that shows up in the illicit finance, national security, law enforcement issue we were just talking about, but it shows up all across the board in financial markets regulation as well. So we're still sort of fighting this core battle about, is decentralization good or bad? And then if it is good, how much of it is necessary to result in no regulation, or what regulation is appropriate even where there is meaningful decentralization?
Yeah, that checks out. Okay, like back to the clarity thing. So what is the current holdup? Like every week there's something new, and it seems like the odds are constantly fluctuating as to whether or not this, gets through, and if it gets through with the provisions that some people are happy with, some people aren't. But what is kind of the current status? By the way, this is March 30th. So this is something that's evolving on a daily basis. So I thought I would mention. I don't usually do like current event stuff, but because this is like basically the prime focus right now of everyone in crypto. What is the current status?
Yeah, I mean, it's good to call out the date because by, literally 15 minutes
Sunday,
it'll be different. Yeah. But where is it now? So I will say the vast majority of the bill is basically already settled. It's hundreds of pages, and it does all sorts of complex stuff like figuring out how issuers of tokens get regulated and how centralized exchanges and custodians get regulated and all that stuff. For the most part, all of that is put to bed. There are very few people who are still trying to make changes to most of those sections. There are just a few key outstanding issues, but those issues might be big enough to stop the bill from moving forward. The big issue that everyone's been talking about is the stablecoin yield issue. And I can give a more in-depth explanation if it's useful, but I'll just say... So
if you want, I mean, I have some like understanding of it, but whatever you want, go ahead.
Yeah, I'll try to give the short version, which is the Genius Act was the bill that regulated stablecoins. It passed last year. One of the things that we had to do as an industry to get the Genius Act across the finish line was basically make a deal with the banks to limit the amount of yield that could be passed to holders of stablecoins. The banks feel very threatened by stablecoins, as they should, because the bank's business model has been for many years to pay literally nothing to their depositors, and that is their business model, is having checking and savings accounts that pay almost no interest whatsoever. Stablecoins come around and say, well, we're just going to pass all of this yield right back to the holder. Well, a lot of people are going to want to hold stablecoins, and the banks don't like that. So in order to get Genius done, we made this deal that limited yield-bearing stablecoins, essentially made them unlawful. But the way that the section of the Genius Act was drafted left open the question whether third parties who are not the issuer of the stablecoin could pay yield to the stablecoin holder, and also whether non-yield rewards could be provided to the holder of the stablecoin as opposed to literally just handing cash over to them in the form of an interest rate. The banks made that deal last year and then decided that they wanted to retrade that whole deal, right? They were not happy with how they had negotiated the bill. And so they have raised this issue with the market structure bill, even though the market structure bill has literally nothing to do with stablecoins otherwise. And they've said, we are going to try to kill this bill by convincing the members of Congress, over whom we have a great deal of influence, to vote no on the bill unless we reopen this question of stablecoin yield. And because the industry really does want to get a bill done, we've engaged in this process with the banks of trying to renegotiate the question of stablecoin yield. Coinbase has been out front on this, and Coinbase has gotten a lot of blame, I think, for slowing the bill down over the stablecoin yield issue. But what we're trying to do now, and when I say we, this is not my main issue, so just speaking on behalf of crypto broadly, is to try to make a deal that maintains as much ability of stablecoin holders to get yield as possible, even understanding it's going to be more restrictive than it was in Genius. And so where the language is landing right now is that the holder of a stablecoin will not be able to get yield solely for holding the stablecoin. They will have to engage in some type of permitted activity in order to get yield. And the debate is over what the permitted activities are going to be. A company like Coinbase would like to be able to pay yield to its subscription holders, for example. And the banks don't want that. The banks want for the stablecoin holder to have to make some sort of fundamental change to the risk profile of the asset in order to get yield for it. Like they would have to stake it, or they would have to trade with it, or something like that. And that's sort of where the debate has been. Let's assume that a deal gets made over stablecoin yields. And I do think it's likely that there's going to be a deal. The White House has been very aggressive in pushing both sides on making a deal. And at least as of this moment, it seems like the contours of a deal are coming together, even if, some people are not particularly happy with it. Then there's the DeFi issue, which we just discussed. Can we get fixes to these sections of the bill that undermine the idea that non-custodial software developers should not be misclassified as intermediaries or as financial institutions? Let's assume we can solve that problem, and hopefully we can solve that problem. Then there's an ethics issue. Democrats don't want to vote for the bill unless something is added to the bill to address the president and his family using crypto because of perceived conflicts of interest. This issue is totally above the pay grade of literally every person who's working on this in crypto. It's just like the president has to work this out with the Democrats who want something to be done, and who knows how that works out, but that could also stop the bill from moving forward. And then there's some other issues. So like Senate Democrats want other commissioners to be nominated and confirmed for the CFTC. There's supposed to be 5 commissioners. Right now, there's just Chairman Seelig. And the issue with getting the bill done is you need at least 7 Senate Democrats to vote yes. And there may not be 7 Senate Democrats who want to vote for a bill where there's not a full commission at the CFTC, and there's not a provision on ethics, and there's, more protection for DeFi developers than they want. So that's really the challenge in getting the bill done. And honestly, I would say it's a coin flip whether we can actually get it done this Congress or not.
Okay, so you mentioned that Coinbase probably is taking a little bit of an, undue blame. At the same time, at least from the perspective of crypto Twitter, it seems that Coinbase is blocking this. Now, what is that? First of all, you probably disagree with the premise, which is fine, and I'll let you explain why. But yeah, what does that look like? Because right now, at least from what we're hearing, you mentioned a bunch of other points, which I don't think crypto Twitter is talking about as much. I want to ask you about the Trump thing in a second. But that's basically what we're hearing, is that Coinbase is basically saying, look, the banks reneged, which seems factually true. It seems like these guys are hypocrites and they're trying to, come back, and change something that they already agreed to. So like we can sit here as rational people and agree that this is ridiculous behavior and we should try to supplant these, these parasitic banks. With that said, if this is sort of the make or break for the bill, it does seem like Coinbase is maybe the only company that cares a whole lot about this. I mean, from what I see on the rest of crypto Twitter is like, I don't care about stablecoin yield. I think this is also, for this personal point here, I think this is grossly, over sensationalized with regards to individuals. Like I made this point when I was talking to this guy, Austin Campbell, a couple weeks ago. Is like most Americans actually, like the velocity of money is quite high and we live paycheck to paycheck. Even rich people live paycheck to paycheck, and most excess assets are put into, the stock market or real estate or paying down a mortgage or whatever it may be. So like all this is kind of negligible to me personally. And I think a lot of other people feel that way, but this does seem to be the sticking point for the time being. And it's kind of bizarre to hear that, like, yeah, I mean, from an ethics, like to take the moral high ground, I'm on Coinbase's side. They shouldn't, like they should be able to do this if banks are allowed to do this. But at the same time, like if this is what's preventing this from going through, like, come on, Americans don't actually, I personally don't care that much, but I understand the premise. So like, I don't know, any reactions to that or responses?
Yeah, a couple reactions. First, I'll say I think sentiment has shifted on this, because I remember when the crypto industry had to make this deal in Genius, a lot of people were really mad about it, right? Because like there was an entire class of yield-bearing stablecoins that people were really excited about, and this deal basically killed all of them, and people were really upset about that. And so I also, I'm on crypto Twitter as much as you are, and maybe not quite as much, but enough to see that, people really don't seem to care much about this anymore. And I take your point, right? Like most people don't mind going through the extra step of taking the cash that they were going to hold in stablecoins and putting it into a money market fund, right? And like, if we can make progress in the bill, well, maybe the money market fund is a token on a blockchain, and now it's even easier to do that, right? It's not a wire transfer between one bank account to some, investment bank account. So I totally agree about that. I think the open question is, if Coinbase wants to try to kill the bill over the stablecoin yield issue, can they do that? And I think the answer is no. I do not think they can. And I don't think that they would try, right? I perceive the Coinbase policy team to be extraordinarily effective. I know them personally. I work with them. I think they are doing the best job they can do to try to negotiate the best deal that they can make for their business. And I will say that this is in large part for their business, right? That this is a huge part of their
because
business.
I think just quick point, like I don't know, there was a tweet that went like somewhat viral that showed the amount that Coinbase makes with their sort of relationship with Circle and how much it's a very, very substantial amount. So like it became like all of this sort of was elucidated, right? When you realize like the incentives here, which is fine to be clear, but like it has become more obvious now. So anyways,
I think like that's very much how typical financial institutions, and Coinbase is a financial institution. They happen to do business in crypto, but they're a centralized exchange. That's how most companies engage in DC. And I think, a lot of people misunderstand that because so many of us are principled advocates fighting for sort of vision of a new financial system that we deeply believe in. That's what brought me to this. And that's why I care about engaging in policy. I think that's true across the board for DeFi advocates. But that's not how most companies operate in Washington. They're looking out for their bottom line. And I don't hold it against Coinbase for doing that. But I think like at the moment where they try to stop the bill from moving forward for this reason, they will get themselves into much more trouble than it is worth for them. And I think they understand that. So, the crypto lobby works very closely together. We are all trying to make as much progress as possible. We have a common adversary in the banks. The banks are not going to be satisfied at stopping stable coin yields, right? They are coming for all of us. This technology is a fundamental threat to their existence as they know it. And so this is a battle that we all should be taking on. But at the end of the day, to your point, the bill matters a lot. And if we can get it done in a way that both gives us strong market structure so that we have a well-regulated on-chain financial system where investors feel confident and institutions want to get involved and retail can participate without being defrauded and scammed every day. And also we can do it in a way that protects developers from a return to a hostile administration. There is zero chance that Coinbase can stop the bill just because it's bad for their bottom line. And I do not think that they would try it.
That's mildly encouraging. Okay, let's go back to a few things you mentioned prior. Like you said Canton. I didn't. I'm happy to throw anybody under the bus, to be clear, but the reason I didn't because I haven't really read about their design too much. I just saw the recent kind of discussion back and forth on Twitter. This was specifically about MEV, but I think it kind of, started to grow into just permissioned blockchains in general. What is the vibe? Like, we kind of addressed this, but I'm a little curious. Like, the reason I ask is because, so I did this podcast with Hester Peirce, and I asked her straight up about like L2s and sequencers. I was trying to figure out like how much she's dug into this because, well, I'll say for me, this was sort of, it really did kind of change things in my mind when you look at like how a lot of L2s function. There is one sequencer, there is like effectively one validator, and to that end it's not that different than depositing into a centralized database, or sorry, a centralized exchange. The ability to exit back to the L1, okay, sure, but like regardless, I asked her this, and I'm always interested in this because I used to like follow this more closely. But what is the discussion like when you talk to, like, call it a policymaker or a legislator who also hears Canton's side about, or I say Canton, I'm using them as a stand-in here, about these things should be permissioned. There should be some validators who can censor transactions. What is that discussion like more specifically now with regards to like multiple validators, how they're structured, right? Hyperliquid's probably I would say on the decentralized side, but it does like have like precompiled binaries, so like it is slightly different than maybe the pure open source of Bitcoin or Ethereum. So like this is the spectrum we're talking about. But what does that discussion look like? I mean, again, I'm maybe sort of asking the same question, but I am always curious about like our understanding of what something looks like in a decentralized way versus does it matter to any of these people in Washington? And then, like with, the Canton discussion as of late sort of brought this back up.
It really depends who you're talking to. There's no sort of, one size fits all of how the conversations sound. Like a lot of people take the fundamental difference between a centralized sequencer and a centralized exchange as being dispositive. That difference being that a centralized sequencer does not control the user's funds, right? Like it sequences transactions and it can deny access to a user to some protocol or type of transaction on the L2, but it fundamentally can't steal your funds from you, right? It's not a custodian in that sense. And so some people will say, I think, rightly to a degree, that this fundamental difference means a centralized sequencer should be regulated fundamentally differently from a typical centralized exchange. On the other hand, some people will say that's too much control. And the centralized sequencer appears as a gatekeeper. And if there's a gatekeeper to the system, the gatekeeper ought to be regulated. And I think, honestly, we've been so stuck for so long in the existential battle of arguing against regulation that just now we're starting to have this conversation of where is the middle path between no regulation and regulation as if it is just a traditional intermediary doing exactly the same thing. And to me, that's where the interesting work is done. So that's where my focus is over the course of the next few years, which with the agencies, to figure out, hey, if we need to regulate centralized sequencers in some way, and I'm saying if intentionally, because I have not gotten into that issue since they are not present on Hyperliquid that deeply. What is the right way to regulate them that doesn't just say we're going to throw out all the benefits of decentralization by calling it a centralized exchange that has to KYC all of its users and take total control of every protocol on top of it, which again is not what a centralized sequencer does. Then there are still those people, as I mentioned before, who are just like, none of this matters at all. All of this is bad. The centralized sequencer has enough control because it has any control that it should just be regulated as a traditional intermediary. The same thing is true for a DeFi developer with limited administrative privileges to make upgrades to only certain risk parameters, for example, in a protocol. The same thing is true for the decentralized governance system, even if the token holders are unaffiliated and dispersed, and even if there's a time lock in governance changes, and even if it's not a fully upgradable protocol, doesn't matter. Those people should just be regulated as if they are a general partnership. And the reason motivating that view is DeFi is bad to begin with, right? We prefer the system of intermediated finance that we've had. And so I think there's just sort of no clear answer. And you have to tailor your argument for every single person you're talking to figure out what matters to them, who has influence on them, what do they care about, and how can you find common ground? That's the only way we're going to get this done.
Yeah. And I take your point with regards, like, I don't, personally have any, again, not that my personal view matters, but I don't take any objection to L2, like with a centralized sequencer. And I do take the point that in like a very weird way, a bunch of dispersed validators when they win a block, they are in charge of ordering. So like in a sense, it's like for 12 seconds on Ethereum, they're the single sequencer. Like, and this is the argument that I've heard made. And yeah, but a lot of this is just like minutia that doesn't matter that much in my view. And I also, you talk about there's not really a contingency anymore of an extreme anarchist, which I don't know if that's exactly how I would phrase it, but like maybe just like an extreme sort of, this stuff can't be regulated. But in some sense, I still do believe this is like practically true about Bitcoin. Like, and I don't, obviously I have my own like biases here, but a lot of times when I do see this stuff, like Dan Robinson, he's kind of also talked a bit about like there should almost be like no securities laws at all. And he talks, there's like this Matt Levine post a while ago, and then he sort of talked about this similarly. I'm sympathetic to that, but I'm very sympathetic to it with something like Bitcoin, where I'm like, try to regulate it. Like, I really do believe that you can't. And so there are like this, the only reason I bring this up is because like level of spectrum we talk about, like there is a far side where you can try to kill this and you can push this into the shadow realm, and you succeed in killing it, then it was worth nothing, and who cares? So like I guess my only point here is that it is interesting to hear that there, like, this middle ground seems to be where it exists in Washington, but there is maybe still like some spectrum out there where, like, I sit, at least with regards to Bitcoin, where I'm like, truly try to kill it. Like, it will continue to push to the fringes, and if you kill it, like, good job. It was never meant to be. So I don't know if that, like, I guess I'm just sort of responding to, that thought, but yeah, it is interesting. Like, and I think there's kind of like a revival of this with Ethereum right now, right? Like with censorship resistance ideas. And I don't know. I think that there are still some like very, very difficult to regulate things, and that will persist.
Yeah, no, that resonates. And to me, there are sort of two fundamental truths behind what you've just said. One is there is nothing that the United States government can do to stop blocks from being added to the Bitcoin blockchain. And the same is true for Ethereum, and the same is true for many other chains. And if they want to try, all they will accomplish is preventing Americans from getting access to these systems. And that is a net negative for the United States. So that would be an absolute fundamental error in policy if we were to try to do that. Could the government say Bitcoin miners are financial institutions that have to KYC all of their users? Sure, they could pass new legislation that does that if they want to. What that means is that there would be no Bitcoin miners in America, and Bitcoin would be a non-American technology. That would be very stupid. And I think that people generally understand that that cannot accomplish the goal of stopping Bitcoin from, adding blocks to the blockchain. So I think that is a fundamental truth. I think the other fundamental truth is that we cannot regulate developers who write code and do not control that code for what third parties do with that code. This is, I think, a much harder challenge right now, because I do think there's a much larger group of people in Washington, policymakers, who want to stop developers from building DeFi. And I think that is what motivated the prosecution of Roman Storm, right? What they argued essentially was he should not have built a non-custodial on-chain mixer that allowed people to get privacy over their transactions, because privacy is bad. And they're going after developers to try to discourage, to chill innovation, to stop developers from building more technology like that. And I'll tell you, I heard that directly from policymakers when I was taking meetings on the Hill and talking about Tornado Cash right after it was sanctioned. And I would explain why the sanctions were inappropriate, why you could not designate a non-custodial smart contract protocol as if it was the property of some person. And the question I got back was, well, then how are we going to stop Tornado Cash from happening again? And I would just look at them like, what a crazy premise to a question. We shouldn't stop Tornado Cash from happening again. We want there to be privacy on chain, and we want to protect developers who want to build software. So to me, those are the two fundamental truths. Beyond that, where you have elements of control, where decentralization is not complete and total, where there is some actor that can affect a system, I think that's where we've given up the idea that we're just going to say you can never regulate this person as anything ever for any reason. And I think that's just because we're pragmatic as an industry in Washington. We want to see DeFi win, right? Like, I came here to win. I didn't come here to mess around. And that requires us to engage with reality. And reality, unfortunately, is not, we're going to end the federal securities laws. Like, that's a beautiful philosophy. And I think there's a really interesting academic conversation to have over drinks about whether the securities laws are good or bad. And maybe we shouldn't have registration for securities or any intermediaries that register at all. But that's just not practical reality anytime in the foreseeable future or our lifetime. So that's why I think that's not something that people in Washington are really talking about.
Yeah, that makes sense. Okay, I have a few more questions. I'm sorry to take up too much of your time, but I think I got to get these. Okay, so the Trade XYZ now is basically offering spot assets, right? And it's been like wildly successful. Also, going back to just a point you made quickly, like, one thing that I find really beautiful about Hyperliquid, and I wasn't early, and I never really traded perps, so I'm not bag biased here, okay? I think a lot of people are, but I'm telling you that I'm not, and I'm finding like what really appeals to me about Hyperliquid is, and why I think that just in general I'm supportive, is because it is evidence and really maybe, in my opinion, some of the first evidence that you can supplant incumbents, like that the traditional financial system does need to work harder. And like, hopefully the decentralized systems win, but at the very least, I do think something like Hyperliquid puts these systems on notice. And we saw this with the oil thing. Now, of course, you can talk about like whether like how closely it tracked, but the price or whatever, you can like make a bunch of arguments about how real this is. But the fact of the matter is there were fintech accounts showing the price of oil over the weekend a few weeks ago. And that is eye-opening. Like, you have Joe Weisenthal from Bloomberg talking about Hyperliquid. Like, this is the first, to me, like real kind of crossing of the chasm. So that's exciting to me. With regards to the like spot assets going forward, explain to me quickly the difference between from a regulatory and policymaking perspective, the difference between basically an Oracle price, which needs just good latency and you can show the price of an asset, versus actually the underlying spot. There's so much talks about tokenization, of securities, how it's not real, how it is real. It's all kind of like minutia to me. But explain to me the difference now with spot. Like, what are the different regulations like versus, you talk about CFTC regulating derivatives. Now, obviously, if there's tokenized securities, that's going to fall under the SEC. Yeah, like talk to me a little bit about now spot and like how this differs from perps and what you're doing specifically.
Sure. Well, first I'll say I agree with you about Hyperliquid.
I hope you do.
I mean, obviously I wouldn't be doing this job if I didn't feel this way about Hyperliquid, but I mean, I've been working in DeFi for the better part of a decade, and you said cross the chasm. That's how I feel about Hyperliquid, right? It's the first product that is just better than what TradFi can offer that I've seen, with maybe a couple of exceptions here and there. But that's what attracted me to Hyperliquid. This is something people want to use because it's better, not just because it's crypto. And I think it is proof of concept that DeFi can work. I will also be the first to tell you Hyperliquid is not the most decentralized blockchain, but that's okay. It's also very new. And if you look at any new blockchain in its first couple of years of development, it always goes from less decentralized to more. And I think Hyperliquid is very much on that path. So I'm excited to see that continue. To answer your question about the difference between perps and spot, and also between spot commodities and spot equities, the difference is that there is no comprehensive regulatory framework for spot commodities. The market for spot commodities is not regulated by the CFTC. The CFTC is the Commodity Futures Trading Commission. They regulate derivatives, not spot commodities. And so the difference between a perp and a spot commodity is that a perp is required to be traded on exchange, with a couple of exceptions, but required by the CEA to be traded on a centralized exchange with mandatory intermediation. A spot commodity is not required to trade that way. Similarly, on the securities side, a security has to trade within the SEC's regulated securities infrastructure. And so the reason we spent all those years arguing tokens are not securities is so that they could trade in a decentralized environment rather than on a national securities exchange or an alternative trading system registered with the SEC. A tokenized security is subject to all the same legal requirements as any other type of security. A tokenized security has to trade on a national securities exchange unless the SEC provides an exemption from that requirement. That's what the SEC is talking about doing now in the innovation exemption, which is supposed to come out, any day now. But spot is different. There's no regulator for a spot commodity. The CFTC has anti-fraud and anti-manipulation authority over the spot commodity markets. So they can enforce against people who are manipulating markets for spot assets, whether that's gold or wheat or Bitcoin or any other non-security digital asset. But that's what the market structure bill is for. The point of the Clarity Act is to create for the first time a comprehensive regulatory framework for the regulation of spot commodities in the form of digital assets. So that's the fundamental difference, and why perps cannot be offered in the United States unless the CFTC takes some action, whereas spot markets for digital assets can be offered in the US, as they have been through centralized exchanges like Coinbase and Kraken and others, and also on decentralized exchanges like Uniswap and so many others.
I had one other thing I was just thinking about, which was, remember that thing called Mirror Protocol, which was like, so that got really shut down or screeched at for offering securities, I think. So I didn't know that you could offer like tokenized securities like in this way now. What has changed? I mean, obviously it was like Gensler being like, draconian with regards to that type of thing. But I remember they got like in a lot of trouble, or at least allegedly, for kind of like having, the way it was designed was like there was a dollar amount backing. It wasn't obviously the real security, but it was kind of like a 1-to-1 backed, and they would like the Oracle price. It was weird design, but it was the first attempt to like tokenize Tesla and Amazon, so on and so forth. So it doesn't seem like people are so concerned about this now. So something has changed. Am I correct or not? Like with the Trade XYZ thing, right? Like this S&P 500, this is spot, right?
So Trade XYZ's S&P 500 product is a perp. It's also not available in the US. And this I do think is the fundamental difference, right? Is like,
okay.
I don't think Mirror was geofencing. And so the SEC was very easily able to say, right, that like this is subject to our jurisdiction. And the question of extraterritoriality, in other words, when can a US agency enforce against non-US conduct, is somewhat open. There's no clear guidance from either agency on what geofencing is actually sufficient to not have the US law apply, or when a transaction occurs within the borders of the United States or not. But generally speaking, if transactions only occur offshore, then US agencies have no authority over them. And that's why the activity that we see now is not subject to regulation and enforcement, because the industry has gotten a lot better at figuring out how do we do this in a way that the agencies aren't going to pursue as a violation of law. And then also, yes, there's definitely a political change where Gary Gensler was going to stretch the law as far as he possibly could to try to kill the industry wherever it showed up in the world. And obviously the current administration has a much more positive view of the innovation that's happening in this space. So that's a fundamental difference as well.
Got it. Well, Jake, thank you so much. This has been fantastic. I could just rattle off questions all day. I'll have you back on at some point, maybe post clarity or not clarity, whatever it may be, and we can talk again. So thank you so much for coming on. Appreciate it.
That'd be awesome. Thanks for having me. This was great.